Welcome back, class, to part 2 of our video lecture for chapter number 4. Let's review by taking a look at the tax return example in chapter 2, where we have a 1040 form completed for us. So the wage income here in line 7, that's probably coming from the W-2 for our taxpayers. We'll learn in a future chapter it's possible possibly to reduce this salary or wage that's taxable by having our taxpayers contribute to an employer retirement plan, either a 401k or 403b, or if our taxpayer has to pay for part of the healthcare insurance, maybe that can be reducing this gross taxable salary. Interest income, this $4,000 amount. So I know a Schedule B should be attached to our tax return because the amount here is greater than the 1500 limit that requires a Schedule B. Even if your interest is less than 1500, it's still taxable. You got to report it here. But if 1500 or more, you got to itemize all that interest income sources on a Schedule B. We have also more interest income that's not taxable, but you still got to disclose it here from municipal bonds. And there's no other income here. Just looking at this interest income for investment purposes, this taxpayer is probably conservative in their financial investing. Maybe one recommendation is to have them talk with a financial planner who probably would advise them to invest in the stock market that would provide dividend income. And if it's a qualified dividend type, it'll be taxed at lower rates. And eventually, if they hold their investments for more than a year, they can have capital gain income also taxed at lower rates. If they have the money, maybe they can invest in real estate and become a landlord. So we'll talk about some of these types of transactions from a viewpoint of taxes in future chapters. So here's our total income, 82,000. And if we had business type income, the business expenses would have already been subtracted on schedules up here like C or E. Again, we have none of those, yeah? Now we do have one adjustment type deduction. That's a contribution to a traditional IRA account. If this was a Roth IRA where the money is being contributed, then you would see zero as a deduction. We'll talk about IRAs in a future chapter. So here's the adjustment being subtracted out to get to our adjusted gross income that on more complex returns may have an effect on the income being reported up here and deductions reported here. The lower the adjusted gross income, the better for tax purposes for other amounts being reported on the tax return. So as much as possible, we try to reduce this number. That's carried over to the top of the next page, page 2 of the 1040, where we're given the amount of itemized deductions, 15,300, which we would compare to our taxpayers' standard deduction, since their filing status is married filing joint. And we'll talk about filing statuses later in this slide presentation. Here, 2,600 standard deduction versus itemized deductions of 15,300. Of course, we're going to deduct the larger of the two. Notice the or here, yeah, not and. Then we also subtract out exemptions. So here's the people deductions. So if you go back to the front of the 1040 form, there's a section for exemptions. We have two personal exemptions for the taxpayer and spouse, and we have one for their dependent daughter. So a total of three exemptions. So if you multiply that 3 by the amount of $1 exemption, here's the total exemption deduction we can claim. Now, if the adjusted gross income goes very high, like the hundreds of thousands of dollars, this exemption deduction can be decreased. Likewise, we'll see in a future chapter, itemized deductions can be decreased if the AGI goes very high. So what we're left over with is a taxable income of $49,050. And because it's less than $100,000, we would find our tax liability for the whole year by looking at the tax tables. So I have a cutout portion of the tax tables right here in the range of 49,000. So we would look up our taxable income going down these two columns, and our taxable income again was $49,050 right at the top of this list here, 49,050. So here is 49,050 and here is 49,050. So which one would we use? You have to read the captions at the top here, the headers, yeah? At least this amount. 49,050 is at least 49,050. 49,050 is not less than 49,050. So once you hit this amount, you know you got to go down to the next line. This is the taxable income row we're going to be using here. And we go across and we stop under our filing status column, which is the married filing joint. You see this asterisk here? Remember there were 5 different filing statuses? Well, here I see 4 columns. This asterisk probably is saying that the qualifying widow or widower or the surviving spouse filing status would also use this married filing joint column. So we go down the column, and when we hit the taxable income row, the intersection should give us our tax liability for the whole year, 6,434. Again, if your taxable income is 100,000 or more, you cannot use this tax table that's located in the instruction booklet for the 1040 form. You have to use the tax rate schedule, also located in the instruction booklet, but probably near the ending pages, around page 100 or so. So we take this 6434 and we put it back on our tax return in the next line. Again, that's the tax liability for the whole year. We're going to learn about alt-min tax in our last chapter of the semester. And now we're going to subtract out tax credits. So here you can see lots of credits. The only one we're going to focus on here in chapter 2 is this one called child tax credits. For each eligible child dependent, you can claim $1,000. So if I go back and take a look at the exemption section at the beginning of the 1040 form where we have our dependent child, there should be a checkbox to say that our dependent is a qualifying child that's under age 17. Not 17 or younger, yeah, under age 17. So 16 by the end of the tax year. Once you hit 17, this $1,000 credit will disappear. I think we're told in the facts of the example in chapter 2 that Betty is 9 years old. So we have a few more years of claiming this $1,000 credit. So if any more check boxes we have here, that would be $1,000, $2,000, $3,000 credit. We have only one. Now, if the income of our taxpayers goes relatively high, again, we're looking at AGI. Ours is relatively low, but if the income goes high, this credit starts to phase out. And the rule is, let's see if we can find the rule, is that if, here's your filing status, and ours is married filing joint, and our AGI, I can't remember the amount here, 76,500 is less than the limit of 110,000. So we don't have a phase out. But let's say the filing status was single for whatever reason in our calculations, and we're claiming one child, $1,000, because we exceed this by, let's take the difference here, 1,500, and we divide it by 1,000. Our answer is 1.5. And for each one or part of 1,000 that we go over this limit, we're going to lose, and we round. You see this phrase, part thereof? That means always round up. In other words, if it's just $1,001, the answer is going to be 1 point something something 1, and you have to round up to 2. So 2 times $50 or $100 is the reduction. In other words, you can't claim all of this 1,000. You're going to have to reduce it by $100 or a credit of 900. Or if you have two eligible children, that would be 2,000, yeah, and you would have subtract out the reduction of 100, leaving you 1,900. But in our case, we're married, filing joint. We're below this limit for AGI, so no reduction. We get the full 1,000 credit. Now, what is not explained to us is that if you cannot claim the full 1,000 here because of the phase out, maybe that unused phased out credit will move down into this. Let's see if I can find it here. Um, Here, this one called additional child tax credit. Maybe the unused phased out credit would have to be calculated here on this schedule 8812 and put down here as another type of credit. So typically you know you're on the right track if this credit here and this credit here comes out with the factors in the thousands. Yeah, like total would be 1,000 or 2,000 or 3,000. But you got to do this worksheet here. There's limitations based on earned income. Now the credits we report up here after this tax are called non-refundable credits, meaning that you can only use these credits to the extent of any tax over here. So if the credits here are larger than the tax over here, the excess credits are either wasted, you can't use them, or in the case of a foreign tax credit, or I believe renewable energy credit, they may be carried over to future years. We'll learn about those rules in our last chapter of the semester. So this bunch of credits again are called non-refundable. Now, and there's more credits down here like we saw for this additional child tax credit. Here's a big one called earned income credit. A couple others down here. If you have extra credits here that are more than the tax liability that's left over here, these extra credits can be refunded to our taxpayer versus non-refunded to our taxpayer. So two groups of credits, non-refundable and the refundable type. And of the two, the refundable type is the better one. And this refundable type includes any taxes you've already paid. In our case, it's the 6,000 withheld from our taxpayers' W-2 form, resulting in an overpayment of this amount that they're going to get back as a refund. Let's move on to our next topic, which is filing status. So using our example in the textbook, we were told they're married and they elect, it's not a requirement, to file a joint return versus separate returns. Almost always it's best or that has no effect if you file a joint versus separate. Separate could possibly create more taxes for the couple. Joint probably will either keep it the same amount or even save you taxes. There's 5 different filing statuses, including this one called qualifying widow or widower or surviving spouse, that our tax book kind of implies it's the same as this married filing joint. So how do you determine which of these 5 filing statuses our taxpayer falls under? Well, you could pretty much have to ask questions or have them go through a checklist or a decision tree like you see here. And then the first question you're going to ask is whether our taxpayers were married at the end of the year. It doesn't matter what their marital status is throughout the whole year. What matters is at the very end of the year. If they were married at December 31st, end of the year, they're considered to be married for the whole year. If they were unmarried at the end of the year, even though they were married for most of the year, possibly through divorce or death, well, I shouldn't say death, but before divorce or separation, legal separation, they're considered to be unmarried for the whole year. So let's say, here's the question, are you married at the end of the year? And they answer yes. kind of bypassing this question for now. The only filing statuses you have is either filing a joint return or separate returns as married. Now, keep in mind, a married filing separate is not the same as a single filing status. That's way down here. Okay, married is married. Now, if you go back to this question, they talk about something called abandoned spouse. So let's say we're working with one of the married couple, one of the spouses in the married couple, and the other spouse has left the home for more than the last 6 months of the year. Not any part of the year, right? But the last more than the last 6 months. That spouse is considered to be, our taxpayer is considered to be abandoned when they're not living with their spouse for the last 6 months of the year. So the next thing we ask our taxpayers if they're a citizen. And we say yes, and whether they're going to be claiming a dependent child. And if they say yes, and even though our taxpayer is married, they can claim the head of household filing status, which is better than a married filing separate filing status. Okay, so again, if we have an abandoned spouse that's a U.S. citizen claiming a dependent child, or this one too, paying for more than half of the household costs with that child, our taxpayer that's married can file as a head of household, which is an exception to these marital statuses, filing statuses here. Let's go back and ask the question again. Is our taxpayer married at the end of the year? And we answer no. Did the taxpayer's spouse die during the year? Of course, they wouldn't be married if the spouse died, right? And we answer there's no spouse that died during the year. Is our taxpayer going to claim a dependent? And just like before, let's say yes. And if our taxpayer pays for more than half household costs, their filing status is going to be head of household. Remember the different amounts of standard deductions? A head of household standard deduction is larger than a single, so as much as possible, we would like to have this versus this. And the key thing is the dependent and paying for more than half household costs. But again, if our taxpayer is unmarried, not going to claim any dependent, and then our filing status is single. Now take a look at this. Our taxpayer is going to claim a dependent but didn't pay for more than half of the household costs. Here, our single filing status dependent still can claim, single filing status taxpayer still can claim a dependent. Okay? But because they didn't pay for half the household costs, they cannot file as a head of household. Let's go back to the question here. Were you married at the end of the year? And we say no. So the next slide is kind of misleading here. Now, did the taxpayer's spouse die during the year? If we say yes, in the year of death, our surviving taxpayer can file married filing joint or separate. And again, mostly joint is the better way to go. It doesn't matter whether our taxpayer remarries or not. If the taxpayer remarries, then the new couple can file separate or joint. But if the survivor here doesn't file and in the year of death, he or she still can file separate or joint with the deceased spouse. Now, if there is a dependent with our survivor, a dependent child, in the year after the year of death, our taxpayer qualifies for the qualifying widow or the survivor filing status. But you gotta have that dependent child with our survivor. And the year after that, you can qualify for qualifying widow filing status. So I believe that's what the 2 tax years refer to here, not counting the year of death. In the year of death, our survivor can be married, filing joint, or separate. In the year after death, with a qualifying child dependent, our survivor is a qualifying widow filing status. Same thing for the next year after that. Now, for the third year after the year of death, this qualifying widow filing status don't apply anymore, and you probably have to go back to maybe head of household. Remember, unmarried with a dependent child, paying for more than half of the household costs. Head of household versus the single, which is less desirable than head of household. So let me kind of illustrate this by giving an example over a time period. So let's talk about two people, right? Taxpayer A and taxpayer B. They're boyfriend or girlfriend or partners living together, and the year is 2017, and these two are unmarried, okay, living together. So what do you think their filing status is or are if there's no dependent for the year? If you go through that flow chart, probably it's going to be single filing status. So let's move on to the next year, 2018. Our taxpayers here are still unmarried, but now we have a dependent child come into the scene. Okay? Dependent child of our taxpayers here. So what do you think our filing status should be here? Well, assuming that you meet the other requirements, one of them can claim this dependent to qualify him or her as the head of household filing status, which is better than the single filing status. What do you think the filing status of the other um, partner is? Remember, these are unmarried, yeah? Unmarried. In a home, you can have only one head of household. The other taxpayer is probably going to be filing single. And the person claiming head of household, the person claiming this child as a dependent, probably should be the one that has the larger income. Let's move on to 2019. How about now they get married? And of course, we still have the dependent down here. Yeah, still dependent. What's our filing status? At the very end of the year, they're married, so there's only two choices, right? Either married, filing joint, or two returns. Each would have a married filing separate. And again, probably joint is always best. It doesn't hurt. Now, there are exceptions to that statement, yeah, but mostly I've never seen a joint return hurt for tax purposes. Our textbook at the end of the chapter talks about maybe filing a separate return because the other partner, the other spouse, has tax problems or unpaid child support, yeah, from our periods for another child. Typically, you can have what we call an injured spouse or innocent spouse filing, where the uh, so-called innocent spouse can still collect their refund versus having it all kept to pay off the taxes or child support of the other spouse. Okay, so I would still possibly file a joint return. Let's move on here. How about 2020? Still nothing's changed. Yeah, still the dependent is there. So probably married filing joint or married filing separate. Let's say tragedy happens in 2021. Our taxpayer A passes away, yeah, leaving our survivor taxpayer B and our dependent there. What's our filing status? In the year of death, probably you want to have married filing joint or separate, but mostly joint. Again, even though our taxpayer is single technically at the end of the year, in the year of death, our survivor can file a joint return. It doesn't matter whether there's a dependent or not in the year of death. Let's take a look at the next year, 2021, 22. Our taxpayer A is gone, leaving taxpayer B and the dependent. What's our filing status? Remember that complicated one we saw where in the year after the year of death, if there is a dependent child being claimed, if our survivor is paying for more than a half of the household costs, we can claim head of household. Sorry, qualifying widow or widower, which has the same standard deduction as married filing joint. Okay, qualifying widow. And that can last for 2 years, 2023. Assume that's the case here. But if we continue unmarried with a dependent child here in the following year, then we're looking at the head of household. Qualifying widow, maximum 2 years after the year of death. In the year of death, still can file married filing joint. For very rich couples, probably what would happen here after the death, you would set up an estate or trust. Yeah, and then a joint return could probably be filed for all of this year, whole year for survivor, part year for um, deceased taxpayer, and a trust or estate would be set up where this would be the beneficiary down here collecting income. So I think this is the 5 different filing status: single, head of household, married filing joint, qualifying widow, widower. Oh, and of course, anytime you have joint, it could also be separate. Yeah. So that's the 5 different filing statuses. So let's talk about children that are being claimed as a dependent. So they're not going to have any personal exemption, but their standard deduction will not be the regular amount we've seen based upon the filing status. Okay, their standard deduction is either going to be $1,050 or the dependent's work income. You see this word earn? Think of it as wage or salary, work income, or even business income versus investment income. And you're going to add 350 to that earned income. You look at this amount, you look at the 150, and you pick the greater of the two. Now you compare that greater of the two to the regular standard deduction for our dependent, which is probably single filing status. For 2017, the amount is a maximum of 3,050. So you look at these two amounts and you pick the smaller. This is the amount of the standard deduction for a dependent child that has unearned income. Okay, not the regular standard deduction. So let's take a look at a tax form that kind of calculates this out for us. If you remember, we were looking at the 1040 form, but here is an easier form called 1040EZ that can be used for only single filing status or married filing, joint filing status, where the taxpayers are not claiming any dependents. And there's only 3 types of income that can be reported on this easy form: W-2 income, wage or salaries; interest income that total less than 1,500. Remember, if you have 1,500 or more, then you got to prepare a Schedule B and attach it to your 1040 form or possibly 1040A form. Or if you have unemployment, compensation, or pay. All those are the 3 types of income that you total up. And here we call it AGI, even though we don't have other income or other deductions being subtracted out. On the easy form, here's our AGI. Now we get to subtract out our standard deduction and exemption, which could total to either this, if you're a single filing status, or this, double it, if it's a married filing, joint filing status. So inside of this 10,350, I believe is the standard deduction of 6,350 and one exemption of 4,050. I think that totals to 10,000. I think I'm $50 off here because this is the 2017 standard deduction. That's $50 more. Yeah, Anyway, the total of the two, standard deduction exemption, should equal this dollar amount. And double it for married filing joint. But if our taxpayers, be it the taxpayer or the spouse, taxpayer or spouse, can be claimed as a dependent, then this exemption disappears. And you gotta start using that formula to possibly reduce the standard deduction. So you would check off whoever can be claimed as a dependent. Let's assume it's just a single taxpayer and this single taxpayer can be claimed, so we check it off. We're told to look at the back side of this EZ form. Let's see if we can see the back side. Here's a worksheet that's on the flip side of the 1040 EZ, where we would put down the work income in line 1 and add 350 to that to get an amount, and compare that to this minimum amount. Any person can get a standard deduction of 1,050. So we compare this with this minimum amount and we pick the larger of the two here and compare that to the regular standard deduction. Yeah, this is the 2016. 2017 is 6350. And of the two, I now pick the smaller of the two. Yeah, and for exemptions, if you've been claimed as a dependent, would be 0. So just this amount goes down here as the standard deduction that you would rewrite over here. Okay. That again is for dependent children with unearned investment income. Yeah, remember the word earn means work income. So with the un here, you're talking about investment income. Now, one of the techniques of trying to save taxes is for rich taxpayers to try to push income to their kids. And the kids are going to be taxed at lower rates because they have less income. So for the government to catch these people, to have them pay their fair share, they're going to charge the kids a kiddie tax. In other words, their income is going to be taxed at the parents' high rates, the marginal rates. So what they do is still allow the dependent children. Remember that 1,050 standard deduction? Okay, so that amount of income is not going to be taxed. But then anything over that, up to another 1,050, will be taxed at the lower rates of the child, which is probably 10%. That's the lowest rate, yeah, besides 0. So if you add up these two amounts, this is going to be taxed at 0 or 10%. And then anything over that, here the unearned, the investment income, over this will be taxed at the parents' rates. And it can get into a quite complicated calculation because certain types of income that we'll see in the next few slides are taxed at lower rates than the regular rate we've been working with. So there are tax forms to calculate out this kiddie tax. If you want to calculate the kiddie tax on the child's return, you would use this form 8615. If you want to calculate the kiddie tax and put it on the parent's return, that would be 8814. I think if there's only one child, it may be sometimes beneficial, especially on the Hawaii tax return, to do this 8615. If you have multiple children in this situation of the same parents, possibly the easiest thing to do is use this 8814 and report everything on the parent's return. We're going to learn in future chapters the taxation of gains and losses, and more so the gain or loss on the sale of capital assets. So again, here's the sales price of what we sold it for, the amount of proceeds you get, less any sales expenses, and we subtract out the cost or the adjusted basis to get a gain or loss. And if what you sell here is a capital asset versus a business asset versus an ordinary income asset like inventory, if this is a capital asset, the gain or loss is a capital gain or a capital loss. If you've held the asset for more than 1 year, the gain or the loss here is long term. If you held this asset for a year or less, then the gain or loss is short term. You would combine all the short-term gains and losses. You would combine all the long-term gains and losses. Then you would combine the long-term gain or loss with the short-term gain or loss. And if what's left over is long-term gain, here netting out all the losses, if what's left over is long-term capital gain, that gain will be taxed at lower rates, lower percentages than the other income of our taxpayer. The other income, you have to report the tax calculated based on the tax table or the tax rate schedule. If the gain is short term, net after subtracting all the capital losses, the short term capital gain, net short term capital gain, is going to be taxed like regular income, ordinary income, regular rates, nothing new there. Yeah. So as much as possible, we want to have capital assets. We want to hold it for more than a year. So now the gain we have, hopefully versus loss, we always want to invest and get gains to have an economic benefit. The gain we have will be taxed at lower rates. This is also true for qualified dividends versus, let's say, unqualified, or I wouldn't say ordinary, yeah, because ordinary dividends or qualified dividends are included in ordinary dividends, but it's only the qualified dividends that, just like net long-term capital gains, are taxed at the same low rates versus ordinary income rates. If you have losses after netting out all of these gains and losses, and the net loss is a capital loss, up to 3,000 of the loss can be used to offset ordinary income, and any excess can be carried forward to future years to first offset capital gains. And if you still have excess capital losses, again another 3,000 to offset ordinary income. Now if you have non-capital asset gains and losses, that's another chapter, really, versus capital gain chapter. We're going to see a chapter regarding something called Section 1231, where the overall effect is we have capital gain treatment for gains, net long-term capital gain treatment, and ordinary loss treatment for 1231 losses. Kind of best of both worlds, but there's some kinks to it in terms of something called recapture, even unrecaptured Section 1250 depreciation. That's all for a future chapter. So here's the rates, the low rates that are going to be taxed to long-term net capital gains. Yeah? And here's the regular rates. So if you add up all your taxable income and you fall within the 10 or 15%, including the capital gain, including the qualified dividends, you would back out those capital gains and qualified dividends and pay no taxes on them. And the rest of the taxable income taxed at these rates in the tax rate schedule or tax tables. Or if your marginal rate, the high rate we've discovered, remember in chapter 1, falls in here, that includes the capital gains and qualified dividends, you would back them out and tax them at 15%, and the rest of your income is taxed at the ordinary rates. Or for high bracket taxpayers falling in this almost 40% rate, they love capital gains. They love qualified dividends because you back them out and tax them and save 20% difference here, yeah? For the past few years, to fund the Affordable Care Act, Obamacare, net investment income, I believe, it has a additional tax. They call it a surtax of about almost 4%. And there's a form you have to fill out. It's not straight this amount, yeah, on the investment income. At the end of most chapters, we're always going to see some tax planning aspects regarding the concepts taught to us in that chapter. But for overall, for tax planning, what you try to do is move income to other people and maybe in your family who are in a lower tax bracket, but you got to watch out for the kiddie tax that applies to unearned or investment income. So if you have business income, one of the key things here is maybe to hire your family so they have work income or earned income subject to the regular tax rates versus the kiddie tax. And your business now can take a deduction for the fair ordinary amount you're paying salary to your family members. So that's one way of shifting, yeah. If you want to shift investment income, you just cannot shift the income. You got to shift the whole investment. Like you have to transfer the stock or the bonds to them and not just the interest or the dividend income to them. Comparing that to splitting income, the textbook defines this by possibly shifting income not to individuals but to different companies. So maybe for big companies, what you see or hear about is intellectual property being transferred out of the country, out of the US, to countries that have low tax rates like Ireland, and they allocate their company-wide, worldwide income to those intellectual property and pay low taxes in Ireland. Of course, they can't avoid that forever. So if they repatriate the money back to the US, they're going to have to pay taxes. So right now, there's talk about having a tax holiday or reduced tax rates if they try to bring that money back in, hopefully to stimulate the economy and create better jobs. Uh, Married filing joint or separate, I don't think this is really a tax planning issue. Again, our textbook talks about using this to avoid um, possibly having refunds withheld for innocent spouses or injured spouses. Again, that can be kind of rectified just by filing a injured spouse form. Now, there are situations where maybe the couple have different income and different deductions where possibly AGI limitations could be lower, but I've never seen that really practically applied in my career. Maximizing deductions is more maybe a matter of timing, either accelerating it to an early year to get past a threshold amount or floor amount, or maybe postponing it to a subsequent year. So again, building it up in that other year where it would be canceled in a low or a lower year. Yeah. Okay, so that's some overall tax planning techniques, and we'll see more at the end of the future chapters. So who is required to file a tax return every year? Now this is different from who should, yeah, who must file, what the law says. Now you should file if you expect a refund because a refund is not going to be automatically mailed to you unless you file a return. But if you have income, you don't expect a refund, do you still have to file a return? Well, if you're single filing status and you have regular gross income of less than 10,400, you are not generally required to file a tax return. This 10,400 is probably equal to the standard deduction for the single filing status plus one personal exemption. Yeah, totaling this. So if your income is this and you minus this two deductions, you end up with zero taxable income and zero tax. You double that threshold amount for filing for married filing joint. Surviving spouse, that's the married filing joint standard deduction and not two but one exemption. Married filing separate, just one personal exemption. You don't even look at the standard deduction. You still can claim it on your return, but for testing whether you have to file in the first place, you don't claim it. Okay, so here's the other two standard deductions and or exemptions for the gross income. Now, there's more than income taxes reported on the 1040 form. So for example, if you owe self-employment tax, meaning that your self-employment income, your business income is more than $400, you're going to have to prepare a Schedule SE to calculate that Social Security tax for self-employment income. Even though you may have zero income taxes, you're going to have a self-employment tax you have to pay, so you're required to file. This advanced earned income credit. It's not too common. There is an earned income credit that is common, but to receive the money in advance is not too common. Um, but if you do have to pay back the earning credit you had received during the year, you gotta file a return. Maybe what's becoming more common nowadays is the paying back of the premium tax credit. With the Affordable Care Act, you can use some of the tax credits to reduce your health insurance premium for the year. But if your situation changes where they're going to reduce that credit, you're going to have to pay back the credit. You have to file a return. This one is we kind of talked about already, the standard deduction for dependents. So when do you have to file your tax forms, that 1040 form? Everybody knows it's April 15th for individual 1040 returns, yeah? If the April 15th date falls on a weekend or a holiday, really not national, but a local holiday recognized, holidays recognized in Washington, D.C., I believe Emancipation Day is not a national holiday, but it's a local holiday in Washington, D.C. If it April 15th falls on that holiday or the weekend of the holiday, it gets pushed to the next business day, and that's for the whole nation. Yeah, for that holiday in Washington D.C. If you cannot file by April 15th, the recommendation is to file an extension form. You can do this electronically also, and you get an automatic 6-month extension. So adding 6 months to April 15, that would be October 15. Again, subject to the weekend or the holiday issue here. Filing an extension only extends the time to file the tax forms. It does not extend the time to pay the tax. So we've seen in Chapter 1 there may be a late payment penalty and also interest being charged. If you're a corporation, a so-called C type, regular type corporation, your due date is the same pretty much for a calendar year corporation as an individual. Would be April, the fourth month, the 15th day for a calendar year corporation. If you're a S-type corporation, where generally you would have to pass on your income to the shareholders, not as dividends, but just like a partnership, your due date is earlier, so these individual owners of partnerships and S corporations can get their information timely. They have to file their tax return for calendar year taxpayers, partnerships, S corporations by March 15, 1 month before April 15 for S and partnership. We have a year end of a calendar year. We've been focusing on 1040. We've seen that simple easy one, yeah? An intermediate one with more income and more deduction than the easy is a 1040A. In all cases here, if you report this income and deductions on the 1040, all three would have the same amount of tax liability, the same amount of refund. So instead of wasting time usually on these simpler forms, most professionals will prepare every return on a 1040 form. And again, the result would still be the same as the easy or the A. Now, if you're doing your own tax return, you probably want to use the easier form. There's less lines to look at, yeah, or the 1040A, less lines than the 1040 form. Besides filing 1040 forms with the government, other entities, business entities, have to file tax forms with the IRS, and copies of these would be also given to taxpayers. The typical one we see is the W-2. One copy, really 3 copies may go to you, and 1 copy will go to the IRS, really the Social Security Administration, and they send their information over to the IRS. And 1 copy would go to your state if your state um, has income taxes. We've talked about 1099s. Here, these are all 1099s, yeah? That means here's our taxpayer. They're receiving income. Whoever's paying this income has to prepare these 1099s. If our taxpayer is making possibly deductible payments, not all, but certain ones, we'll call this deductions here. And whoever's receiving these deductions may issue out a form called a 1098. So the common one would be a home mortgage interest reported on a 1098, or student loan interest 1098E, or tuition paid to your college, your post-secondary institution 1098T. Yeah, 1099 receiving income, 1098 paying deductions, paying expenses. So we have 1099s for interest income, probably received from your bank or credit union or insurance company. 1099 for DIV, received from your stockbroker or companies you invest in, or exchange traded funds. G for government refunds or unemployment compensation. R for retirement, your pension, profit sharing, 401k, 403b, IRA distributions. For B for broker, here's when you sell investments versus receiving dividends on your investments. And here's the catch-all, yeah? Miscellaneous. If you're one business paying money to another business and the receiving business is not a corporation, technically you need to issue out, the paying company needs to issue out a 1099 miscellaneous. So if you have a Schedule C business and you provide services to another business, that other business, your customer, is going to issue a 1099 to you. Something similar to a 1099 miscellaneous is a 1099 letter K, that's issued out by credit card companies or companies that process credit card charges, like Uber drivers, Lyft drivers will probably get a 1099K from Uber or Lyft. And because the government has a copy of this information, they expect probably to see it on your file, the 1040 form. And if the information, the amounts are not there, maybe you're going to get a correspondence audit notice from the IRS.